We have the Bigger Pockets podcast is dropping on May 16th. And one of the deal structures that I talked a lot about on the podcast was BEAF style investing, break even, appreciation focused. It was really funny. We had a couple of good laughs about come down to Texas, get some Texas beef. It was funny. It was good. That's like the focus. And we should be driving a lot of that type of client here in the next couple of weeks. So BEAF stands for break even, appreciation focused. It means that you're focusing on high quality areas, high quality inventory with upward pressure in terms of population, upward pressure in terms of number of jobs in the area, and the median wages are also increasing, right? If you've got all three of those factors, you're going to have a lot of upward pressure on price, not just in terms of resale value, but also rental rates, right? So the whole strategy behind this is you're really using real estate in its highest and best use, or its highest and best form, in my opinion, and that's with a levered return. So you could take 20%, put it down on a $300,000 asset. So you're all in for 60 grand on this thing. And if that $300,000 asset goes up by 10%, right now you just added $30,000 to your net worth on a $60,000 cash outlay. That's a 50% return in 1 year. That's where wealth is generated in real estate, especially with appreciation focused real estate. So that's kind of the goal that we're targeting for these clients. And there's a very specific archetype of asset that fits that mold that we're looking for. We want it to be recently built, so built within, say, the last 10 years. The reason why is because that'll really reduce the amount of CapEx that you have to outlay. And most of the time when you're running your pro forma, you're going to set aside 10 to 15% for CapEx and maintenance, especially if it's a 1940s, 50s, 60s build, because you're going to have routine maintenance that comes up month after month. When you buy these BEAF style recently built assets, you don't need to have that cash set aside. So in reality, you're really running a cash neutral kind of business, at least for the first year. So your expenses are fixed, right? Because you're going to get a 30-year fixed rate mortgage on this thing. So your expenses are largely fixed. And year after year, because you buy into those areas that have increasing population, number of jobs, and wage growth, your rents are going to continue to increase, right? So cost is fixed, rental income is continuing to increase. Then in years 2, 3, 4, 5, now you're cash flow positive and you're in an A-grade asset in an A-grade area that's appreciating aggressively. That's the winning formula for these BEAF style deals. And we're getting a lot of interest in this type of inventory from high W-2 professionals, people who are out of state. It's a lot easier to manage. It's a lot less stress to manage a BEAF style deal from out of state than it is to do a renovation project or a BRRRR deal, or even getting into these high cash on cash return multifamily projects that are in, say, Killeen or Temple or the south side of Fort Worth or the south side of San Antonio. It's a lot easier and less stress and more, I think, consistent returns, focusing on high quality inventory rather than these C grade multifamilies that were built 50 years ago. So that's the model in a nutshell. I know I just threw a lot at you. Was there any clarifying questions? Anything that I can touch on again?
I heard, so obviously anything under 10 years, high quality areas. You said high quality areas, and what else? High quality what?
So you're going to be focusing on high quality inventory. So the asset itself, you want to make sure is basically turnkey. That's one of the hallmarks of a BEAF style deal, is that house is pretty much turnkey. It's going to qualify for every type of financing. It's going to look beautiful. It's going to show beautifully. You should be able to get into that thing with a cleaner and be ready to rent as soon as you get a deep clean.
So it's something that can rent out turnkey, but also will appreciate over time.
Yep.
Okay.
And in terms of financials, what I usually look for is for the rental income to be $200 or $300 above the pity payment. So it's going to be about $200 to $300 above your principal, interest, taxes, and insurance. That means that you're going to have a little bit of buffer there to cover the little things that pop up. And if you've got an increase in taxes next year, you've still got a little bit of a buffer above your pity payment. And you're not going to be stretched every single month to pay for the house as large as you're going to pay for itself. And that's probably the last piece of this thing. If you were to look at cash flow from a very cursory level, income minus expenses, income minus like your debt service, or to look at it from a Robert Kiyosaki kind of perspective. Is this house going to pay for itself? And can you go out and buy a whole bunch more? The answer here is yes, at least for the first couple of years, because you're buying such a high quality asset with very high quality tenants. They're not going to take they're not going to beat on the house much. And you know that you're going to have a really aggressively appreciating rental rate. So that's like where we win with these, right? So it's a levered return. That's what you're playing on. High quality inventory, high quality locations, like assets and inventory that like you'd feel fine moving into on your own at night. We want to be just like good, high quality kind of inventory to add to your portfolio that you're proud of. That's beef. That's beef real estate, if that makes sense. Okay.
Texas beef. Are you taking into account property management costs for those? I know these ones are very easy to manage yourself because they're headache free, and you're gonna have a very high quality tenant, like you just said, that's not gonna be ringing your phone. So
Right.
what I tell clients a lot is maybe just have a handyman, if they are out of state, on call for those 2-3 times a year that they need to run over there. So that's kind of, is that what you do with your clients?
Exactly. Yeah. And that's how right now I'm able to manage like all of our real estate, right? Because almost all of it is high quality, like single family homes, or they're in really good areas. And they don't need a lot of hand holding. If we get one of these janky quadplexes that are 80 years old, and you've got constant tenant turnover and constant plumbing issues, and you've got all of a sudden the door won't latch shut. And like those are the things where you need a manager for, because you have constant month after month maintenance and like stuff that needs attention. Whereas these beef style deals, they largely take care of themselves, right? So you can be an out of state owner, you can manage it on your own, as long as you've got a handyman who can run over and take care of that one-off situation that happens every quarter. All right, cool. Any other kind of questions on that or things that we can clarify?
I like the idea of that.
Sweet.
Do you have an example property in mind?
Yeah. Yeah. So we're gonna put this one under contract this weekend. We already like have the offer accepted, but they're not gonna take it until we go under, or until the client comes into town to see it. This is like a perfect example. 2601 Wayne Ave. She's putting 25% down to purchase it. It was built in 2020, right? So it's only 3 years old. It's in a really high quality subdivision. It's a single story, 2,000 plus square feet. It's going to command a great rental rate. I think the rental rate on this is probably like 2,500 a month, 26, maybe even as high as 27. I'm not sure. Let's see, what does this have?
Probably pushing 27 if it's over 2,000 square foot.
Yeah, I know comps that had a handful here that were at least at 26. So we could probably push to 27, especially because we're going to be closing here in like peak rental months. So this is like a quintessential example. It's below the median price for Dallas, right? So DFW median right now is sitting right around 400,000. So this is below the median. There's a nice little pullback in terms of the asking price recently. So look at this. This is something that you could lease out right away if you wanted to. You just go through with a deep clean. It's not going to need any capex. It was a 2020 build. 4 bedrooms, so you're gonna put a family in here, and they're gonna stay for a couple of years. Very low vacancy. That's the goal. This is like the examples that you look for.
Okay.
All right, cool. Did that answer your question, Adrian?
Yeah. I just wanted to see an example, and I already had something like that in mind.
Yeah. Those are the ones we really, and also they're a lot easier to close because you don't have all these little hurdles to jump through in terms of making sure they appraise and making sure that there's no repairs that are needed and making sure that you don't have a dramatic foundation settling or outdated plumbing issues. Like these ones are just a good long-term buy hold. The best kind of avatar to purchase is usually a high W-2 earner. They're usually out of state. Maybe it's somebody who saved 100 grand and they're looking to invest in an area outside of the Bay Area, California, or outside of Seattle, where $100,000 doesn't even fund the earnest money for a deal. This is the type of asset that works well for that type of buyer. And we should be seeing a pretty big influx of these types of buyers coming through here in the next couple of days, which is why I just wanted to have the conversation quick.
I know that the markets that you're pretty bullish on, obviously we have Collin County, North Dallas, maybe Forney, Texas as well. Any other specifics that you want us to focus on that have been really good for you?
Yeah. So I keep flirting with the idea of these townhouses in north central Dallas, like the Highland Park kind of area, because you can buy these townhouses for sub 400 and they lease out for $3,000 a month. It's like the numbers are getting too good to continue to ignore them. So I'm like, is it worth getting into a non-freestanding home, something that I know is harder to sell on the back end because it has such higher cash yield and it's in like a downtown kind of area? That's something I'm like on the fence about. So if I've got a client who really loves it, we'll go that direction and we'll do those townhouses in north central Dallas. I'm still there. There's other markets, for example, outside of Houston, you can get into like the Woodlands area on the far west side of Houston along like the energy corridor. You can find good stuff that way. Toward like Spring, Texas, you can find good stuff that way. New Braunfels is a great beef market. New Braunfels right between Austin and San Antonio. That's a really good area where there's a lot of new construction inventory with good prices for good rent to price ratios. So that's a market as well. To be concise, probably Aubrey, Salina, Forney, Little Elm, if you can find something there, sub 400. And then as you get south, maybe you can touch Georgetown, but probably not really. New Braunfels is really solid. And then toward the Woodlands in Spring if you're over by Houston.
Cool.
What do you think on an area like Sherman, where we know that TI Instrument or Texas Instruments going out there, Global Wafers going out there, places like that? It's an older area, but there is new construction, and we know that growth is coming.
Definitely. Yeah, great option. Also, if you've got a client who's looking in that lower price range, 200 to 300,000, go Sherman all day. That's an excellent market to target.
Okay.
I like North Fort Worth as well. Saginaw, Hazlet, following 35 up to Manhattan.
Yep.
Really good school districts. Some of the top, like the fastest student population growth is in Northwest ISD. And that's the same kind of price range, 300 to 350 if you have somebody right in that ballpark.
Yeah. What I've seen over there around like Northwest and how do you say it? Watauga? Is that it?
Yeah. Yep.
What I've seen over there has been the rents have been my phone.
Unknown.
The rents over there have been a little bit lagging compared to the north side of Dallas. Have you, and that maybe it's just because I haven't done like a deep dive into the rents over on that side of the metro in probably a year. What are you seeing for if it's a 4-bed, 2-bath, 2,000 plus square feet in Saginaw? Money, what's that leasing for?
They'll not really break in 23.
Okay.
So they're like that break-even payment. So if they're okay with that, then it's a good option, but they don't have that $200 buffer that like you were talking about before. So the rents have not quite caught up yet.
Yeah, that's in general what I've seen. There's way more inventory over there though, and you're a lot closer to 300 than you are 400 if you're on the Fort Worth side of town than on the Dallas side of town. But I do see a lot of that strong growth over there. And if you're looking for something that's just like percentage gain, right? So where are you going to have the fastest doubling event? It's almost always going to be in those in those asset types that are closer to say 300,000 because it's easier for a $300,000 asset to go to 600 than it is for a $400,000 asset to go to 800. Just because your buyer pool for a $600,000 asset doesn't have to change a whole lot. Like the demographic of buyer does not have to change in an area. Usually that person who buys a $300,000 house at some point in their life is going to be able to afford a $600,000 property without a lot changing. Whereas getting into 800,000 to $1 million, you're going to have a demographic shift. And it's a lot harder for that to happen than it is for the populace to pretty much stay the same, just get older and save more money. Does that make sense? That was kind of like a soapbox.
Yeah, most definitely.
So if you've got somebody who's specifically looking for the highest internal rate of return, the highest rate of appreciation, I would go for those lower priced assets on the Fort Worth side of town. If you've got somebody who's more cash flow conscious and they're like, hey, I like the idea of a beef style deal, but I want to see a little bit more of a buffer, I would go to those first markets that we discussed, Aubrey, Salina, Forney, Little Elm, Providence Village, and then south into New Braunfels or even farther east into the Woodlands in Spring. Okay.
Yep.
Cool. All right. thanks for jumping on. Any other little questions before we wrap up and get running for the weekend?
I'm good.
We're good. Yeah.
Sweet. All right, guys. Appreciate you. Hammer down, and hopefully we get a dozen properties under contract here in the next 2 days.
Sounds like a plan.
Yeah, that's the plan. All right. See you
Thanks.
guys.
Have a good
See you
weekend,
guys.
guys.
Bye.